First off, we're pretty sure that pretty much a definite majority of people that are dialed in tonight are dialed into these next two presenters. We're going to learn about the Smith Maneuver, and we've got two great people to talk about. We first off have our power team member, Keaton Kirkwood from the K&B Mortgage team. They are investor-focused mortgage brokers. And along with him is the creator of the Smith Maneuver, Rob Smith from the Smith Consulting Group. So gentlemen, welcome and take it away.
Thanks for having us, Devin.
Thank you, Devin. Firstly, thanks everybody for having us here tonight. Very pleased to be here. Devin, one slight correction. It was my father that developed the Smith Maneuver back in the mid 80s. I have now taken the reins, so off I go. So there's a lot of information to pack into 20 minutes. This is going to be like an open fire hose. So once we're done here, of course, any questions are welcome, but there's always more information on smithman.net, which is our website. So I'll just try to share the screen here at this point. And how's that looking?
Perfect.
Okay. So welcome everybody. The Smith Maneuver. We're just going to dive right in. Now I want you to forget about investment real estate for a moment here. We're going to bring that later into the presentation, but what we're talking about now is your principal residence. Do you own a house and do you have a mortgage? How can we make that work for you? Now, your mortgage, that very thing that allowed you to buy your house and raise your family and peace and serenity, also happens to be the very thing that threatens your peace and serenity because it's so bloody expensive. I mean, even with today's low rates, they take a big cut off our paycheck. And this is the math that not a lot of people do. I imagine a lot of you folks do, but your typical Canadian won't really do this. What does a mortgage really cost you? $400,000 mortgage at 4.5%, 25-year AM. If you're at the 38% marginal tax rate, we know that you have to pay that $400,000 back. We also know that you have to pay interest on that, but you're also making these payments with after-tax dollars. So you have to earn, in order to pay back that $400,000 mortgage, well over $1 million. Not cheap. So we Canadians in general do not have it easy. We pay more in taxes than we do food, clothing, and shelter combined. We've got inadequate pension systems out there. We've got, and unable to save enough for ourselves. Large part of that is the mortgage expense. And we've got kids, they're expensive. We have to deal with inflation. On and on it goes. It's not easy. We have to take action. We have to take action. That's what a lot of you folks are doing, if not all of you. You're actively investing in real estate, and that's fantastic. You're doing something. We have to. Now, we Canadians have two generally pressing financial goals. One of them is we want this expensive mortgage gone. The other is we want to be able to retire one day. We need to start saving for our retirement. But the decision of which of these two goals to attack first is made for us, but not by us. Because we know that if we don't prepare for our retirement by putting money aside each and every month, no one's going to come knocking on our door. But someone certainly will come knocking on our door if we're not making our mortgage payments. So there's this sequential approach. Most Canadians, they first attack the mortgage. Once they've had that paid out, they no longer have a mortgage payment. So now they can start saving for retirement. Well, guess what? It's too late. You're already at or very near retirement. It's too late. You've missed out on all these years of compound growth. So this sequential approach of mortgage and then start taking care of your retirement leads to a number of scary places. Living on a small fixed income. I'm sure many, if not all of you, know someone who lives in a clear title home with hundreds of thousands of dollars of equity, but they haven't saved enough. OAS CPP isn't enough, and they're living on a small fixed income. Maybe we end up being financially reliant on our children, living in their basement suite. Maybe we're forced to downsize. Maybe we're forced to sign up for a reverse mortgage. We work for the bank for 40 years to pay off this mortgage. We hit retirement, clear title one day, we do the math, we don't have enough cash flow for retirement. We have to start selling the house back to the bank. Or what's another potential destiny? You know, you take a look around next time you're in a big box store, fast food restaurant, and you'll see plenty of senior citizens there. They're there because they have to be, not because they want to be. No one has our backs. We have to take care of ourselves. We have to take action. So how do we do that? We can reduce our tax bill. We can eliminate costly expenses as fast as we can, such as the mortgage, and we can invest for our future as early and as often as possible. Now, you folks won't need too much of a discussion on this. You guys are real estate investors. You're very clear on the fact that there are two types of debt. There's non-deductible debt, which destroys wealth. There's tax-deductible debt, which creates wealth. If we borrow to consume, not only can we not deduct the interest from our income, but we're also buying assets which decline in value: cars, groceries, vacations, steak dinners. But if we borrow with the reasonable expectation of generating income, we can deduct the interest. And in order to be able to deduct the interest, we necessarily have to be buying investments which have a fantastic likelihood of increasing in value over time. Two very different types of debt. The wealthy understand this very clearly. That's why they're wealthy. Now, a lot of Canadians, not necessarily you folks, will judge their wealth by how little or how much debt they have. They feel, oh, I'm clear title, I must be wealthy. Well, if this person on the left has no debt, they have no mortgage, the reason they have no investments is because they've been concentrating on paying down that mortgage. They got a $700,000 mortgage house and that's it. But if I use the equity in my home and have a 100% tax deductible investment loan of $300,000, that has allowed me to accrue assets of $740,000. So clearly, if I understand the nature of debt, good versus bad, I'm able to be better off by utilizing debt. So net worth is our measure, not the amount of debt that we have. So use your equity. Unproductive equity equals negative return. If I've got hundreds of thousands of dollars in equity in my principal residence, I'm not putting it to work. It's earning me 0% on paper, but what's the real return? It's negative because of inflation. So use your equity, and your mortgage can be one of your biggest investment opportunities. The mortgage of your principal residence, the house in which you live. So what happens with the Smith Maneuver? Well, it converts your 100% non-tax deductible mortgage to a 100% tax deductible investment loan. Each month you're generating valuable and increasing tax deductions. They increase over time. You're able to eliminate your expensive mortgage in record time. And each month you're able to invest money you wouldn't otherwise have available. This happens now. This all happens simultaneously, and it requires no extra cash flow from you on a monthly basis. All we're going to do is restructure the existing personal financial situation we have to work to our advantage. How does it work? We make a mortgage payment, whether we're doing the Smith Maneuver or not. We continue to make the mortgage payment if we're doing the strategy. And each month, part of that mortgage payment reduces the balance owing on that mortgage. With the appropriate financing, which Keaton can talk to, we're able to re-borrow that equity that we've just created with the mortgage payment, and we get it invested. We borrow with the reasonable expectation of generating income, and we do this each and every month. And because we're doing this, the government is taking too much tax from us every 2 weeks off our paycheck. They get our tax return at tax time. They say, we owe you money back. So there it is. There's our tax refund that otherwise, if we weren't implementing this strategy, we would not receive. We take this refund, we apply it as a prepayment against our mortgage, reborrow that amount to invest as well. So here's a typical mortgage. I get a down payment. I go to the bank. I need $400,000 to buy my house. Great. It's 100% non-tax deductible. Why? It's considered a consumption. It's considered consumption borrowing because I've got no reasonable expectation of generating income from my principal residence. 100% non-tax deductible. The readvanceable mortgage, which is what is required for the Smith Maneuver, has that same non-deductible component that I borrowed to buy my house, but it's also got a line of credit, a secured line of credit attached to that. It's linked. Now, this is a very basic demonstration of a readvanceable mortgage. There's different types out there, but this will give you the idea. This readvanceable mortgage is one mortgage with two components, non-deductible and this investment loan, which will be 100% tax deductible. But what we do with the amount of equity that we can reaccess every month when we make that mortgage payment is very important. If we borrow to consume, if we borrow to make a car payment or go on vacation, we cannot deduct the interest on that borrowing. All we're doing is replacing non-deductible debt on one side of that mortgage with non-deductible debt on the other side of the mortgage. Wealth destruction. But if we borrow with a reasonable expectation of generating income, we can deduct the interest, wealth creation. So let's say I've got a mortgage payment of $2,200 a month. This is a bit outdated, but currently less would go to interest and a bit more to principal. But for sake of argument, let's say $1,470 of that $2,200 payment goes to interest, non-deductible. It's expensive. but 730 does reduce the principal balance from 400,000 to 399,270. The mortgage lender says, well, you paid down that mortgage by 730, so we'll increase your line of credit limit. Who's doing that? Anyways, we'll increase your line of credit limit by $730. So that's what we borrow out to invest. And this happens on a monthly basis. I don't know why that green is on there if everyone else can see it. But each month we reborrow the equity that we create with that mortgage payment and get it invested. And pretty soon we've got a $400,000, 100% tax deductible investment loan. So what we're looking at here is because it's 100% tax deductible, we get tax refunds that otherwise we wouldn't receive. We're able to take these tax refunds on an annual basis and prepay that mortgage, which means we're out of that non-deductible debt faster. Therefore, we're making less in interest payments on that non-deductible debt. And because we're investing on a monthly basis with money that otherwise we wouldn't have, and also those annual tax refunds, we're taking advantage of compound growth now. For the typical Canadian homeowner, what I just described there is the plain Jane Smith maneuver. And it's worth about several $100,000s, and it can take about 3 years off the amortization of your non-deductible mortgage. Now, and that plain Jane Smith maneuver is simply using that mortgage payment that you are making anyways, nothing else. But there are a number of accelerators available. There's a debt swap, cash flow diversion, the DRIP, prime the pump, cash flow dam. I'm going to go through these pretty quickly due to time. But what's the debt swap accelerator? Let's say I have $10,000 of investments, mutual funds, stocks, bonds, whatever they are, ETFs. And I've had them for a while. They're doing good things for me. I like them. Well, what I can do is redeem these investments for cash. I use that $10,000 in cash to pay down my non-deductible mortgage debt. The line of credit limit opens up dollar for dollar, and I reborrow that $10,000 and I can buy the exact same investments that I just sold a week or 10 days earlier, or I can buy a different investment. But I've immediately converted $10,000 of non-deductible debt to deductible debt. Very valuable. And I can also do this with cash. If I got cash sitting around, pay down my mortgage, reborrow it, and invest. Cash flow diversion. A lot of people, they get their income from their job or wherever it is coming to their personal checking account, and they're doing good things by saying to an investment company or something, come into my account and take $300 and get it invested for me each and every month. Fantastic, they're on the right track, but what could they do? They could take that $300 and first prepay their mortgage, reborrow that $300 and then get it invested. You're accelerating the conversion of that non-deductible debt, you're increasing your tax refunds, and you're still getting invested. And it didn't require any new funds from you. You were already getting that invested. The DRIP Accelerator. If I've got an investment and it's earning dividends monthly, quarterly, annually, whatever it is, a lot of people will have those dividends automatically reinvest to buy more shares or more units of the investment. Well, I can request those dividends to come to me in cash, and then I can use them to prepay my mortgage, reborrow that $300 in this case, and then buy the exact same stock or mutual fund that was sending me those dividends in the first place. And these dividends, whether I have them reinvested automatically on an annual basis versus sending them out to me in cash, there's no difference in the tax treatment. So again, this is no new cash for me. So here's where it starts to get interesting for the real estate investors amongst us, which is probably every one of us. Prime the pump accelerator. If I'm in the wrong type of mortgage and I want to do the Smith maneuver, chances are I got to go talk to Keaton and get the right type of mortgage, which is the readvanceable. And in this case, I go and get my house appraised and it comes in at $500,000. With a readvanceable mortgage, the lender will only loan up to 80% loan to value. So now, because the old mortgage I have doesn't work for the Smith maneuver and its balance is $400,000, I need the full $400,000 that the new lender is willing to offer me to pay out that existing non-deductible mortgage debt. So therefore, the line of credit starts at a $0 limit. I have to wait until I make my first mortgage payment to reduce that, and then I can borrow to invest. I don't have any lump sum available to invest right away. But if my house comes in and appraises at $600,000, the lender is willing to lend me a total of $480,000. But I only need $400,000 to pay out my current mortgage. So they say, well, we've paid out your old mortgage, $400,000, but our total limit is $480,000. So we'll give you $80,000 available on that line of credit right away, day one. I can pull out this 80 grand, some, all of it or none of it, but I can pull out this 80 grand and I can invest it. I can invest it in securities, in a new business, or investment real estate. So with his audience today, this 80 grand, simply because I refinanced my home and the house value has gone up a little bit, and over the course of years, I've been making my mortgage payment. Now I've got $80,000 of available equity. There's my down payment for my first piece of investment real estate. Or there's my down payment for a second piece of investment real estate. Now the cash flow down. This deals with rental properties. So now that I've gotten my first rental property, I've got a renter in there, I've got a mortgage on it, but I got a renter in there, and he sends me $2,000 a month. What most Canadians in this position would do is they'd send that $2,000 into the bank account that they set up for their rental property, and then they turn around and make the mortgage payment on that rental property. So 2,000 in this case, it's cash flow neutral here, 2,000 in, 2,000 out. Well, they're missing out on a very valuable opportunity here by implementing the cash flow down. What could they be doing? Well, that $2,000 still comes in from the renter, but I take that $2,000 and I make a prepayment against my own mortgage on the house in which I live. 2,000 down, this line of credit limit opens up by 2,000, and I reborrow that to then make the mortgage payment on my rental property and service the other expenses. I'm reborrowing. I'm borrowing to invest in my own business, and there's a reasonable expectation of generating income. In fact, there it is. Now, if I'm prepaying my mortgage above and beyond my regular mortgage payment, if I'm prepaying that by $2,000 a month, this non-deductible debt disappears in record time. You know, we've seen 25-year AMs go to well under 10 years. Now, I mentioned that this requires no new additional cash from the homeowner. And the reason and that can be questioned by many people because, well, I'm making a mortgage payment whether I'm doing the Smith Manoeuvre or not. But if I am doing the Smith Manoeuvre, now I have this line of credit balance, which is increasing on a monthly basis as fast as my non-deductible debt is going down. And if no new money is required from my pockets, who's servicing that increasing interest expense? And the answer lies in the increasing efficiency of the regular mortgage payment that you're making. My constant payment each month of $22.14, the very first month, most of it goes to interest, but $728 goes to principal. So I borrow that $720 out and I invest it. Next month, same mortgage payment, but a little bit less goes to interest. Therefore, a little more is going to principal. I borrow the full $730. I only invest $728, which leaves $2 left over in my bank account, which the lender comes in and takes it and says, thanks for the interest payment on that first month's borrowing of $728. The next month, I'm able to reborrow $733. I do so, $733 out. I only invest $728, and there's $5 left over in that account to service the interest expense on the first 2 months borrowing. And so that's how no new cash is required from the homeowner on a monthly basis. So each month, you're able to invest money you wouldn't otherwise have available. It's simply the cash from your regular mortgage payment, which you now have access to. Each month, because you're borrowing to invest, you're generating valuable and increasing tax deductions. That resultant refund allows you to prepay your mortgage at least once a year with money you otherwise wouldn't have, which means it's gone sooner. And it starts now. The benefits occur simultaneously. And again, no new cash from you is required. Now I'm going to go through a very quick demonstration of the Smithman calculator. But before I do, smithman.net, there's the book. My book, Master Your Mortgage for Financial Freedom, it's up there. If you don't want to buy the book, go to the library and check it out there. But if this interests you, read up on it. There's also the Smithman calculator. We're going to go through that in a second. Smith Manoeuvre Honer course, frequently asked questions. So there's lots of information on the website. Please do not get your information on the Smith Manoeuvre from the internet or the forums. There is so much misinformation. There's so much, just don't do it, please. Now, the Smith Manoeuvre Certified Professional Accreditation Program. I'm certifying realtors, mortgage brokers, investment advisors, mortgage conveyancers / real estate lawyers, insurance agents, and accountants across Canada so that these SMCPs, Smith Manoeuvre Certified Professionals, are able to help Canadians regardless of locally, regardless of where they are in Canada. So if you're interested in being connected, Keaton Kirkwood is a Smith Manoeuvre Certified Professional Mortgage Broker. But if you're looking for professionals, either get in touch with Keaton for the mortgage side or myself at info@smithman.net for any of the other types of professionals. I strongly urge you not to use any professionals who are not Smith Manoeuvre Certified Professionals. Keaton will tell you if asked that it's a pretty rigorous course that they go through and they learn all the ins and outs. And it's pretty important to do this right. We're dealing with mortgages, we're dealing with investing, we're dealing with the CRA, for Pete's sake, as if I had to say it. So we got to do it right. Now I'm going to briefly stop the screen share so I can get to the calculator. Where am I? And I know this is really fast, people, but not a whole lot of time. There's more information out there. So the calculator, here it is. Keaton, can you nod if you can see this?
Yeah.
Thank you. So I'm just going to create a scenario here. And so this is what it looks like. So this first page, personal information, I'm making $170,000 a year. I can type in different types of investment income, pension income, but I have a rental. It's a proprietorship. It's not in a corporation. It's a proprietorship, so I can implement the cash flow dam. And I'm earning $36,000 a year in rental receipts. I don't need any of this rental income for living expenses because I'm employed. This rental property cost me $34,000 a year. There's my total income. Assets, let's say I've got mutual funds of $30,000. I'm just going to leave, I got an emergency fund of $10,000 as well in cash. Liabilities, I could enter deductible and non-deductible. I might wish to consolidate or preserve at refinance. Down here, this marginal tax rate is automatically calculated based on BC rates. You're in a different province and you know your marginal tax rate, you can just type it in there. So I go to the next sheet, mortgage information. First, my home value. Let's say it's worth $775,000. The mortgage balance on that is $500,000. The mortgage rate is 2.7, let's say. And 25 years is the default for the amortization. There's my monthly payment. It calculates $22.90. Now on this readvanceable mortgage, I just filled in the information for the non-deductible mortgage loan component. Now I'm going to type in that readvancing line of credit component. Currently prime is at 2.45. And let's say there's a premium of 0.5% on that. So my total borrowing rate on a monthly total borrowing rate is 2.95%. So here is where we start to see some results. Investment assumptions. I can put in anything I want. I can put in 4, 5, 6, 8, whatever type of portfolio growth rate I estimate to be earning. I'm going to put in 7% over the long term. What this is telling me here, that out of that monthly mortgage payment, the very first mortgage payment, I have $899 to invest. Now I can choose to invest less than that if I want, but forget it. I'm going to invest all of it. So each month I'm going to invest $899. So right away we see some improvements here over that amortization, original amortization period, $125,000 in tax deductions based on my marginal tax rate, $57,000 in money back from the government. We'll see amortization improvements in a second here. But on a net worth side, already my portfolio is worth $707,000. It's offset by my 100% deductible investment loan. So there's that net improvement of $323,000. And it's just from restructuring my mortgage and using my mortgage payment, which I'm making anyways. This is a little complex to explain, but your Smith Manoeuvre certified professional sure knows how to use this. I can reduce the amount I accept from the lender in order to improve my results for a number of reasons. I'm going to accept $600,000 from my lender, even though they're willing to lend me $620,000. So we saw automatically, if you noticed it, a little bit of improvement in our net worth and taxation. So here, where I choose to apply my annual tax refunds against my mortgage and then reborrow that amount to invest, we're going to see improvements in net worth and also in amortization here. So just doing that, these refunds that otherwise I wouldn't be receiving, I'm taking 2.17 years off my non-deductible debt. And so my net worth improvement also goes up to 433. So what we just looked at there is the plain Jane Smith maneuver using nothing but your regular mortgage payment. Now I've got the accelerators I can implement here. I got $30,000 in mutual funds. I'm going to sell them for cash. I'm going to apply that cash against my mortgage. I'm going to re-borrow it and then buy the exact same investment back if I want. Now I've taken 4.3 years off my residential mortgage. My net worth improvement is 612, meaning my investment portfolio is over $1 million, offset by the 100% deductible investment loan, 420. If I know I'm getting money in the future and how much it is, I can implement it here and it'll apply that to the model in the future. I got $10,000 in cash as an emergency fund. I don't like it earning 0% or less than zero. I'm going to go get a personal line of credit, swear up and down to my spouse, the banker, and God that I'm not going to use it unless it truly is an emergency. So I can take this cash and put it to work by prepaying my mortgage and then reborrowing it to invest. 4.92 off the mortgage, 671 net worth improvement. Cash flow diversion. I'm already investing $300 a month into an investment plan. I'm going to first direct that against my mortgage, and then I'm going to reborrow to invest. So no new cash. I was already investing this on a monthly basis, just going to run it through my mortgage. So 4.92 and 671 goes to 7.75 years saved and 913 net worth improvement. And I like this so much, I am going to come out of pocket with my own cash. $50 a month. Great. Things improve a little bit more. But here's where you your real estate investment folks, this is what you'll appreciate. My proprietorship, my rental property brings in $3,000 a month. It costs me $28.33 a month. So that difference between what I'm getting and what it costs me is available to invest in securities after I prepay my mortgage by $2,000 and then reborrow that, $3,000, then reborrow that $3,000, make my mortgage payment and those expenses, the difference I can invest. So the AM of 8.17 saved and 952. Now I've saved 17, almost 18 years off that mortgage. It's gone in just over 7 years. And my net worth improvement is 1072. What was it before? 952. Straight to the prime, the pump accelerator here. Based on the numbers that I've inputted, I have $100,000 limit on that line of credit day one, the day that this mortgage goes through. I can pull this out to do anything I want with, but if I'm disciplined and I'm implementing the Smith Maneuver, I want to pull some or all of that out to invest. And I can pull this out to invest in investment real estate, or I can pull this out to invest in securities. The calculator assumes you're investing in securities at that growth rate that you've already inputted at the beginning of this sheet. Now, let's say I only want to pull 50 of that. I always want to have $50,000 available on that. Just makes me feel good. Well, I pull $50,000 from that line of credit. I get it invested directly, and that net worth improvement goes from 1.072 to 1.349. So I've got an investment portfolio of 1876 offset by 100% deductible investment loan of 526, gives me a net of 1349. And the end result is I'm out of this mortgage non-deductible debt in 7 years. And I've earned $156,000 in tax refunds back from the government. So lastly, there's a pretty little graph. So those are the numbers of this scenario. The investment portfolio in the red. The original amortization of this mortgage is the green line heading down to 0 in 25 years. The actual with this program is the blue line heading down in 7.1 years. And that yellow line is my total debt, because as fast as I'm paying down my mortgage on one side, I'm reborrowing. So my total debt stays pretty much constant. And then I can print off a report, which just summarizes this. It summarizes the inputs, and it tells me what I need to do on a monthly basis based on those numbers. So, well, that was quite a lot of information. I did a lot of talking there, and I need a sip of gin. So, Keaton, is there anything you want to say on the mortgage side?
Yeah, I just want to add that a lot of the Smith Maneuver is about making sure you get the correct product set up properly. Just having a readvanceable mortgage doesn't necessarily mean you can do all these strategies. And it doesn't mean that it's going to work effectively for you. Some lenders only allow prepayment once a year. Other lenders allow prepayments, but they have a 30 to 60-day lag time before the funds become available. One of the things we look at is how are you going to utilize the Smith Maneuver? Some lenders only allow one mortgage or one line of credit component as an example. So if you have different investment streams and your accountant wants to keep them separately, that's not an option. Even more importantly, if you're going to have non-deductible debt that you're going to be using a line of credit for and deductible debt, we really, really want to keep these separate So there's different products that will work well for different clients, depending on what the overall plan is. And we try to build that together. It's kind of the nutshell of selecting the right product, but just know that simply looking for a readvanceable product on its own doesn't do things for it. It doesn't work correctly. You need to make sure that you get the right product set up correctly as well. And then the only other thing I want to touch on is if you're going to use this for real estate investing, once again, we want to make sure that we put the planning in to make sure we're not getting you into a product where you start implementing the Smith Maneuver, you get enough money for your down payment, and then you don't qualify for your investment property, because then we're wasting a lot of time for everyone and you're probably not going to be happy. So I do suggest that if you're going to go that route, to actually plan it ahead, make sure that the broker you're working with knows about it, and that they're actually, we're building your plan with the end in mind, as opposed to just the next step.
Yeah, I'll add that, every once in a while there's someone, they want to implement the Smith Maneuver and they're comparing readvanceable mortgages. And because they're not a financial professional, they think that the most important thing is rate. Rate is by far the most important thing here. So like Keaton said, there's prepayment allowances. There's a way to sort of set yourself up even before you're able to technically implement the strategy. There's a lot of moving parts. What happens if there's a relationship breakdown? What happens if you need to move house? What happens if your car blows up? There are a lot of different things that happen in life. And if you just simply go to your bank mortgage specialist, I want a readvanceable mortgage, I want to implement the Smith Maneuver. The what? Well, okay, whatever, I can get you a readvanceable mortgage. When you need help, they're not there because they don't understand. So really it is to your benefit. It doesn't cost you anything to go to a Smith Manoeuvre certified professional mortgage broker. I mean, all these professionals, they get paid the way they always have. So there's no change here. But if you're going to do it, use a professional. I've seen too many people blow themselves up trying to do it themselves, because there's a lot of things that aren't top of mind that your Smith Manoeuvre certified professional will understand.
Do you want to take questions, Robinson?
Sure.
So I think one of the things that is a little bit vague that a bunch of people want clarified, and I'll let you tackle this, is how people can draw on their line of credit and not have to use extra cash. I think a lot of people aren't following the efficiency side, so maybe you can re-say that in a different way.
Sorry, I was just looking at a question there, Keaton. So explain how no new funds are required.
Yeah, how the extra efficiency, where if you draw the amount of your very first payments principal paid on every month, how you can use the extra efficiency to service the HELOC.
Yeah, basically, a constant mortgage payment, whether I'm doing the Smith Maneuver or not, that's not going to change on a monthly basis. But as soon as I do the Smith Maneuver, I'm now reborrowing each month. So I've got an increasing balance on that line of credit. And if that constant mortgage payment is still going to that non-deductible side, like it would whether I'm doing the strategy or not, if I'm not having to come up out of pocket to service the increasing interest expense on this growing investment loan, this line of credit, if it's not coming out of pocket, where's it coming from? And we have to remember that on a monthly basis, you've got a mortgage balance and a constant rate. This rate is being calculated on a smaller and smaller and smaller balance as each month as time goes on, because you're paying some of it down with some of that mortgage payment. And therefore, the amount that goes to interest is a little bit less because it's being calculated on a lower balance. So therefore, if a constant mortgage payment, less is going to interest, more is therefore going to principal. So every month I'm able to borrow, and it's not a huge amount, this increase, but I'm able to borrow more than I was the month previous. And this continues. But if I invest a constant amount, the amount equal to my very first regular mortgage payment that I was able to pull out to invest, if I leave it there, then I'm reborrowing more and more and more. And there's excess cash by the end of the month growing in that account, bank account, which hasn't gone to invest. And the mortgage lender, we've instructed them to come into this very bank account to take the interest on that line of credit. So at the end of the month, most of it has gone to invest, and a little bit of it has gone to service interest. So we're back down to zero or close to it. So I don't know, is there any other way that you can explain it, Keaton?
Not particularly, really. At the end of the day, you're freeing up more money on your line of credit than you're reinvesting, so you have extra funds available to pay for the line of credit. It's kind of the simplest way that I can say it. It's something that, if anyone wants, I can explain it on a phone call, or we can kind of go back and forth. I find that sometimes it just has to be explained to you a few times, and then all of a sudden it clicks. So not a problem there. So one other thing that was asked, Robinson, I believe you've given a partial answer on this before. If someone owns investment properties in a corporation, can you do the cash damming strategy? I always thought the answer was no, but I believe the last time we did that podcast, you said that there was a potential loophole.
Well, it's not it's not necessarily that you're implementing the cash flow dam as per I've described it as relates to proprietorship. But if I own a corporation, 100% I own it, it's still a completely separate legal entity. So now I can take income from that corporation, just like I get paid from my job, or maybe I take dividends from that corporation, whatever, and I can use that cash flow to prepay my mortgage, and then I can re-borrow to invest in that corporation. Maybe I'm buying more shares of the company I actually own already, or maybe I'm extending a shareholder's loan to that corporation. And because it's a loan, I have a reasonable expectation of generating income. But there's two legal entities now. The taxation is more convoluted. And this is why you need to really talk to an accountant who understands what's going on. They can structure this corporation that you own to the best tax advantage to pull out and prepay your mortgage and reinvest into it, or whatever the case may be. And sometimes it may make sense to do that. Sometimes it may not. So with a rental property that's a proprietorship, or any proprietorship, it's a home-based business. Maybe you knit sweaters out of your garage and you sell them for whatever on the internet, right? You've got revenue from that business. You've got expenses for that business. You got to buy the wool. You can implement the cash flow dam there because it's a proprietorship. You can do it with a corporation, but it's not exactly the cash flow dam. You need to talk to an accountant who understands this completely. Don't try it yourself.
So, gentlemen, I'm going to jump in there. Keaton and Robinson, I just want to say thank you so much. My mind is blown. I thought that I had a bit of an understanding of the Smith Maneuver, but Robinson, you have just absolutely impressed. And it's great to know that Keaton is certified with the Smith Maneuver, and he is also on our power team. Questions have been coming in like crazy, and Keaton will, I'm sure, get to every one of them. If not tonight, then Jen is going to be making sure that contact information for both gentlemen is available. So again, thank you so much. Man, I certainly want to be chatting more about that because I think that's just some fantastic strategies. So thank you both.